Welcome to this explainer. Today, we're focusing our analytical lens on CareTrust REIT, trading under the ticker symbol CTRE. Now, if you've glanced at their financials recently, you know there's an absolute mountain of data to sift through. But hey, don't worry, that's exactly what we're here to do. I'm incredibly excited to break down these really dense financial metrics and transform them into a clear, structured report card. We're going to see exactly what's under the hood of this real estate investment trust, and we'll use the numbers to tell the true story.
Just to make sure we avoid any data overload, here's our exact roadmap for today. 1. Stock overview and returns. 2. Revenue, margins, and growth. 3. Valuation and fair price. And finally, 4. The dividend story.
Okay, let's dive right into Section 1, Stock Overview and Returns.
Let's lay some groundwork here to start. CareTrust is currently trading at $38.95. That gives them a very solid market cap of $8.536 billion, which really plants them firmly as a major player in their space. And looking at the year-to-date return, they're sitting at a highly respectable 8.88%. So these figures kind of anchor us, right? They show a healthy, sizable company that's currently seeing some really positive momentum this year. But to truly understand this stock's personality, we need to look back just a little further.
And this brilliantly illustrates the historical volatility, as well as the massive recent recovery this stock has experienced. In 2022, well, it was a tough year, pulling back down 13.69%. But if you focus on the sheer resilience and the leap that followed, we see quite the shift. By 2024, it surged up 26.31%, and in 2025, it rocketed by an absolutely incredible 39.35%. So this definitely isn't a slow, sleepy stock. It's capable of massive swings and, recently, tremendous upside momentum. 396.12%. Just let that number sink in for a second. When you step back and look at the 10-year return, this is the long-term payoff for patient investors. Despite those year-to-year market swings we literally just looked at, nearly a 400% return over a decade shows that CareTrust has been a phenomenal wealth compounder over the long haul.
Let's move to Section 2 and see how this builds: revenue, margins, and growth.
98.83%. Guys, this is their gross profit margin, and it's an absolutely jaw-dropping metric. What this tells us is that CareTrust is exceptionally efficient at retaining its gross revenue. For every single dollar that comes in the door, they keep nearly 99 cents before operating expenses even kick in. In the real estate investment trust space, efficiency is the name of the game, and this right here shows they're operating at a masterclass level. Now let's talk about momentum, because this is where things get really exciting. Tracking the net income compound annual growth rate over a 5-year period, we see a solid 31.73%. But fast forward to the 3-year mark, it explodes to 248.11%. And even trailing 12 months, it's maintaining a blazing 156.59%. This momentum has accelerated so dramatically over the years. The company isn't just growing. The rate at which their net income is growing has shifted into total overdrive.
Now, what's really interesting about this slide is the sudden dose of reality. Amidst all that blazing net income growth, the trailing 12-month free cash flow is sitting at a stark negative $954.961 million. Now, in the world of REITs, a massive negative free cash flow can often be tied to aggressive acquisitions and property investments, basically deploying heavy capital right now to fuel future growth. But it is a massive outflow of cash that we absolutely must acknowledge when we're grading their overall financial health.
Which naturally brings us to Section 3, Valuation and Fair Price.
This is arguably the most anticipated part of our report card, comparing what the stock actually costs today on the open market versus what these underlying metrics say it's actually worth. And here's the shocking disparity. On one side, you have the last close price at $38.95. But on the flip side, when we look at discounted cash flow models, the intrinsic fair value price is calculated way up at $92.94. Mathematically speaking, the stock is trading at just a fraction of its modeled intrinsic value.
And that leads us to this exact percentage, 58.09%. This represents the current margin of safety for investors buying at today's price. For those of you who follow value investing, a 58% margin of safety is a massive structural advantage. It essentially means that even if the growth projections end up being slightly overly optimistic, you've got a huge cushion already built right into the current stock price.
Let's briefly translate some of this valuation jargon to reality. The price-to-earnings, or PE ratio, sits at 25.13, and the forward PE is 2132. Now that might sound slightly elevated on the surface, but crucially, the PEG ratio, which actually factors in the company's growth, is an incredibly low 0.26. Generally speaking, anything under 1 suggests a stock is undervalued relative to its growth. So a PEG of 0.26 implies that despite the PE of 25, the market is heavily discounting CareTrust's massive growth trajectory. You're getting that growth incredibly cheap here.
Finally, let's pivot to our last bucket, Section 4, the dividend story.
If you're looking at a REIT, you are almost certainly looking for income. So we need to examine exactly how effectively CareTrust returns value to its shareholders. And honestly, these robust growth rates build a very compelling case. You have a current dividend yield of 4.01%, which is very healthy. Evaluating the growth of that payout, there's an 8.03% compound annual growth rate over 5 years, which then accelerates to 11.66% over the last 3 years. So not only are you getting a 4% yield today, but the momentum of those payouts is actually speeding up.
So the crucial point here, the ultimate punchline is this: 12 consecutive yearly increases. This is the absolute proof of the company's reliability for dividend investors. They haven't just paid a dividend, they've steadfastly committed to raising it year after year through literally all kinds of economic environments for over a decade.
But how safe is that growing dividend? Well, the payout ratio sits at 72.22%. I impartially note this because for a REIT, this is a highly critical metric for dividend safety. A payout ratio of 72% means they're easily covering their dividend obligations out of their earnings, while still leaving plenty of room for those future increases we just talked about. It's really a strategic sweet spot.
So, what does this all mean? We've arrived at our final question. Given the massive 58% margin of safety on valuation, offset by that stark, nearly $1 billion negative free cash flow, is CTRE the right fit for your portfolio? You have highly attractive upside and stellar dividend reliability, weighed neutrally against the clear cash flow realities of heavy capital deployment. It's a fascinating balance, for sure, and definitely one worth applying to your own investment strategy. Thank you so much for joining me on this explainer. I hope this report card brought you some incredible clarity today. Keep learning, and I'll catch you next time.